Let's get back to the jobs report. The U.S. economy added fewer jobs than expected in August, but the market today, largely still higher following this week's news of more trade talks with China. Let's bring in Peter Novarro, Assistant to the President and Director of the Office of Trade and Manufacturing Policy. So, Peter, you said last month that we're in a situation where consumers have not been hurt and China is bearing the entire burden. Does the jobs report today, new information, make you reconsider that statement at all? Is it becoming clearer to you at all that maybe trade uncertainty is impacting labor decisions?
Not at all. China is paying the full burden of these tariffs. After all, they're slashing their prices, and the Chinese yuan's gone down by it's going to approach 15% since the tariffs were put in place. And look, if you put a 15% tariff on China and they devalue their currency by 15%, you don't get a lot of shifting to consumers. Plus, there's no sign of inflation in the data, and I wish the Fed would take better note of that. In terms of the jobs report, that jobs report was very healthy. We are at 3.7% unemployment. That's 18 months below 4%, which is a 50-year record there. If you look kind of behind the curtain at the numbers, I think one of the interesting things for me is we keep adding to the prime age workers back in the workforce. We're at about 1.5 million now. When I was on the campaign with President Trump, we were very concerned about people who had left the workforce discouraged and were sitting on the sidelines with no hope. 1.5 million is nothing to sneeze at, and that labor force participation rate keeps moving up. We've got over 1 million jobs in construction and manufacturing since the president was elected. So a lot of good things. Wages are going up, and for the African American community, just seemingly every month the news keeps getting better and better. I mean, we have historically low unemployment rates for minorities. So we like this number. It's a good number, and the economy we think is rock solid. Having said that, though, we need a little help from our friends here to do their job. President Trump's doing his, but we need Congress to pass the U.S.-Mexico-Canada agreement as quickly as possible. That'll add a point of growth and quite a bit of jobs. We need the Federal Reserve really to lower interest rates. I'm hoping they go 50 basis points and 100 by the end of the year. And people ask, why would you do that when we have a strong economy? And the point is that we like 2% growth, but we love 3% growth. And it's curious to me, and I don't know if you've talked about this on your show at all, but I never hear the Federal Reserve chairman or members of the Board of Governors really address what to me is one of the most important downsides of the Fed's high interest policy, which it's pushing up of the American dollar, really disadvantaging our exports, encouraging a carry trade where people are borrowing the euro cheap and buying the dollar and making money off our backs without creating a single job. To me, it's extraordinary that the Fed has not acknowledged that portion of the negative that higher interest rates that the Fed has on this economy.
Well, Peter, I want to ask you a little bit about Fed policy and maybe the interaction with trade policy. I'm sure you're aware of, kind of what Bill Dudley started with some pretty controversial comments in his op-ed.
Controversial.
Yeah, well,
what is that? What a 10 on a scale of 1 to 9? Yeah, that was pretty controversial.
Well, so let's just talk though about the interplay, perhaps as you see it in the administration, between Fed policy and trade policy, because I think there are, or there is a sense, and perhaps I'm interpreting your language incorrectly, but if the Fed has easier policy, you perhaps in the administration could, in your view, better carry out the trade goals that you are searching for. I mean, is that kind of a way that you see the interplay at this point?
So, look, let's just look at the data first. When Jay Powell began his 100 basis point rate hike, set of 4, What we saw is an immediate jump up in the U.S. dollar. And what that does to real GDP growth, and we saw it in the second quarter, is it directly impacts investment in a negative way and indirectly impacts our exports through the higher currency. So we've seen the dollar, it got as high as almost 10% after the Fed rate hikes. I think it's around 7 or 8% now. But we're facing next week a very interesting situation, which the Fed really does have to take note of in terms of this currency issue. The ECB, the European Central Bank, is going to announce a very, very aggressive round of monetary easing. And at the same time this week, we saw the Chinese do the same thing. They loosen their credit reserve requirements. And what that's going to do is put further upward pressure on the dollar, and it's a form of monetary mercantilism against the United States. And if you look at the difference between Q1 and Q2, in Q1 we had real GDP growth of 3.1%. A full point of that was due positively to the tariffs, particularly on China, where our trade deficit went down, so we grew faster. In Q2, we lost 2/3 of a point by lower exports, primarily due to the Fed and a currency effect. And then we lost a couple, like maybe 0.2 to lower investment, and then the random shock of Boeing shaved off 0.4. So the Fed, I get back to this whole idea. It's like, why isn't there an awareness amongst the Board of Governors that when the Fed raises its interest rates far above everybody else, that drives the dollar up, creates interest rate spread, that creates a carry trade that further accentuates the strong dollar, and that hurts us in terms of exports and growth. Instead, all I hear from the Fed is, oh, it's somehow trade tensions, which we find ridiculous. We have tariffs on China, but we don't have tariffs anywhere else except for steel and aluminum, and that's a relatively small amount. Yet they make a big deal out of these so-called trade tensions when the dollar, the strong dollar effect is staring them in the face.
Well, but certainly, I mean, the data, let's take Europe, for example. Their manufacturing sector is almost certainly in recession right now. We've seen some negative data from the U.S. manufacturing sector. And I think that that in a time where the global economy is under stress, the dollar has been a safe haven, and that the dollar is going to strengthen all else equal.
Tell me why the European economy's down. Tell me how that's our fault.
Well, it's not that it's our fault, but it is what it is, right? I mean, the Fed.
Well, it is what it is, and that's the problem, because the European Central Bank is cutting rates, and in the chess game of central banking, as you know, whenever a central bank changes their interest rate policy, other central banks have to decide whether to match it. If the ECB cuts their rates and we don't match, then our dollar goes up, their euro goes down. We're able to send fewer exports to them, and our growth suffers. So we're just, like the Fed's playing checkers in a chess world here, as far as I'm concerned. I mean, here's for Europe, what really should happen, and I've said this repeatedly over the last month. The biggest thing that Europe needs to do is what? German fiscal stimulus. Germany is the country that's dragging down much of Europe now because of their so-called black zero policy. I don't know if you ever discussed that on your show, but it's a policy of fiscal austerity where they're just not consuming enough either at the government level or at the personal consumption level. And that low consumption is a direct function of fiscal austerity policies that the German government imposes on their people. I mean, if Germany were to engage in fiscal stimulus, that would provide a tremendous stimulus to Europe and the rest of the world.
So more on the trade tensions. I mean, the market obviously is paying attention to what's happening with trade. And this week in particular, we saw the easing of tensions there lead to a rally in equities. What details, though, can you give investors about talks coming in October? Because when it's amorphous, what seems to happen is there's a couple days where people think this is okay, and then it peters out. So do you have any details about when this is going to happen and what we can expect from talks in October?
So let me tell you a couple of things. First of all, I have what I'm trying to sell for the last couple of weeks is Novarro's rule here, and that is when you hear something about the trade talks or something about White House policy, if it's not quoted directly from Steve Mnuchin, the Treasury Secretary, Bob Lighthizer, the United States Trade Representative, Larry Kudlow, the National Economic Council Director, Wilbur Ross, the Department of Commerce Secretary, and myself, then it's probably fake news. What happens is, and this is really important for investors, what happens is we don't leak. The five of us don't leak. So what happens is you've got a lot of mischief out there trying to put out some fake news to get us to reveal details of the ongoing negotiation. That won't happen from any one of the five. So what people have to do is simply be patient and let us negotiate behind closed doors, and then if and when we have a deal, we'll be fully transparent. So that's really important. The other thing I have to tell you, and for your viewers, if you're going to handicap the probability of a deal, if you're going to speculate on an outcome, it's important to remember what I've referred to as China's 7 deadly sins. They are the 7 structural issues which we are negotiating with China about, because this is not really a trade deal like it would be with other countries where they lower their tariffs, we lower ours, and everybody goes home happy with a Ricardo textbook in their bed. What this is a case where we have the 7 deadly sins, and let me just walk through them. It's the Chinese cyber intrusions into our business networks to steal our trade secrets. It's the forced technology transfer as a condition of American companies gaining access to the Chinese market. It's intellectual property theft to the tune of several $100 billion a year. It's the dumping of products, everything from steel and aluminum to robotics and exotics into our markets for the purpose of putting our companies out of business. That's 4. Number 5, it's the massively subsidized Chinese state-owned enterprises. When we have to compete with China Inc., that doesn't work so well. Number 6, currency manipulation. And we've seen since the tariffs have been put in place that significant falling of the Chinese yuan. And finally, and this is a very serious issue to the President of the United States, as it should be to everybody watching this, made in China fentanyl and other opioids are going to kill about 100 Americans today, about 1,000 this week, and over 50,000 this year. And dating back to December 1st in 2018 at the Buenos Aires G20 summit, the Chinese promised that this would stop. It hasn't stopped, and just last week, the Mexican government, the Mexican Navy interdicted 23,000 kilograms of fentanyl in the high seas bound from Shanghai to Toledo and beyond. So those 7 structural issues are what the negotiations is about. And so as people watch this and handicap the outcome, this is what we need to settle.
It is incredibly complicated, and I think people have gotten their head around that the longer that this has gone on. I want to ask you about a couple of reports that are out there, and this has to do with the hurricane damage in the Bahamas. How would the administration react to the Chinese government getting involved with trying to rebuild the Bahamas, as you just laid out all of the many issues that go part of this trade deal?
Totally not my lane, and I have absolutely nothing to say on this. I would lose my credibility if I were to speculate on things I know nothing about. So let's not go there.
Peter Novarro, you said, you guys don't leak, that it is the 5 of you, and we should go by what you guys are saying. Is there anything you can tell us about what a deal would look like and handicap it in October? for real, like what it looks like?
That's really a great question, and the second important thing that your viewers need to know about, besides the 7 issues, is that we had a deal. We had a 150-page plus agreement that was in these 7 verticals that dealt with each of these issues plus enforcement. It was negotiated over, I think, 11 negotiating sessions, up to and including commas and paragraphing. And that's the basis for moving forward, but the Chinese walked away from that. And in many ways, this deal will be determined by what the Chinese want to do. We know what we need to do. The president is firm about standing up for America. And I think you would grant me this, that in the 2.5 years the president's been in office, he has changed this country's understanding of the China problem. And right now he has very strong bipartisan support and public support for standing up to China. So the short, quick answer now is we need to go back to that original deal, those 7 verticals, deal completely with all of those structural issues. It can't be a halfway thing. And I think that both China and the United States would be better off if we got to that place, as would be the rest of the world. We can't have a country as large as China simply being in the World Trade Organization, breaking every one of its rules, and treating us like a piggy bank. The president will not stand for that.
Thank you so much, Peter Novarro, Assistant to the President and Director of the Office of Trade and Manufacturing Policy. You have a great weekend as well.
All right.